Welcome to Making Money with Matt McCall. I am Matt McCall. Thanks for joining me here today. It is Thursday, January 13th, and of course, we got a big show for you coming up. We're going to talk about the markets, which have had a bit of a rebound lately. We'll talk about the inflation number and what that really means for you. We have the headline numbers, but how does it affect your everyday? We're then going to talk about Bitcoin. I talked about it earlier this week, bouncing off support. It continues to rally. We're also going to talk about some investments that might be your hedge if inflation continues to move higher. And of course, we're going to dig into the mailbag. All that and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me today. It is Thursday, January 13th. I appreciate you all tuning in. And we got the markets doing pretty well recently. Even some of the tech stocks have been bouncing back, not as nicely as I would like, but we're still there. So we're going to take a look at the S&P 500 right now. And as you can see here in the chart, we are up. This is early morning here yet, so we're not too far into today, but we're up about a quarter of a percentage point. We're about 13.5 points right now in the S&P 500, but well off that low of last week, I should say of Monday. And we talked about this on Tuesday when the market broke down on Monday. We broke some really important support levels. As you can see here on the S&P 500, something I want to show you is if you drew a line right here, we have a very distinct uptrend. And that uptrend right there is a series of higher lows and higher highs. That is the epitome of what an uptrend is. And you can see here that tail that we left on Monday, that was the intraday low, but we closed near the high of the session. That is actually extremely positive. But for me to really get excited about it, we need to see follow through. And we saw that. We had a big day on Tuesday. Wednesday, we were up a little bit. And then again, today, Thursday, up again, another about 0.25%. So far, so good. If everything follows the patterns as it should, there's more than likely we will see the S&P at a new high at some point in the next couple of weeks, and maybe even sooner. So now let's take a look at the QQQs, which is the NASDAQ 100. And as I mentioned last week, the NASDAQ 100 is the 100 largest stocks in the NASDAQ that are non-financials. So think Apple, Microsoft, the big names you know. So it's up slightly today. It's up actually minimal. It's up less than 1.1%. But again, as you can see, we had that big tail. And again, we could draw a line right here connecting these lows. So it's making higher lows on every pullback. That's a very bullish trend. At the same time, we held above this blue line I talked about. That's the 200-day moving average. It's a long-term trend indicator. And again, we were down so low, down to 370 on the QQQs, ended up closing around 380. That was on Monday. Big follow through on Tuesday, up a little bit yesterday, and again, up slightly today. But again, the pattern that we're seeing is when you have that type of tail, that type of selling, and then you close near the high of the session. I was saying Tuesday that I felt kind of that pit in my stomach. I felt what we call capitulation. It felt as if everybody was saying, I'm done, throwing in the towel, walking away, hands clear. And that feeling, when I get that, and I did not do that, if anything, I'm looking to buy, but when I get that feeling, that is typically a good time to buy, whether it be a short-term bottom or a great long-term bottom or near a bottom. I'll be honest with you, nobody picks the bottom of the market and buys it. If they tell you that, they're probably lying to you. And nobody sells at the top. It's just not realistic. And if you have, maybe 1 out of 1,000 trades you do, good for you. You're going to get lucky once in a while. We all hit the jackpot every once in a while. But let's be realistic. So for me, when I see this type of action on the chart where it breaks down, comes back up, and then follows through, historically, if I look back on the chart when this has happened in the past, they've been nice buying opportunities. And then I throw in my gut feeling, because the people I was talking to felt like they were throwing in the towel. When I feel that way, I put the two together. And it usually turns out pretty well. So that is the NASDAQ there. That's how it's holding up. So overall, again, the markets look pretty darn good right here. There's not much I can say more than I said Tuesday. We want to see this follow through. We're getting it. But again, I still think when it comes to solid companies, buy all dips, because I think that's the best way to go. So I want to show you another chart now. This chart is of Bitcoin. And we talked about this exact chart last week. And as you can see here, this blue line is what I drew. And you can see on this blue line, I'll make this chart bigger for you. As you can see here on this blue line, this was a little bit of resistance back in June. Then it was support in September. We had to pull back in September. rallied to nearly 70,000, pull back again. This is, this is almost a classic. I'll give you a little quick chart lesson here really quick. Potential head and shoulders, which is negative. And a head and shoulders, you can probably see it here. Here's your left shoulder, and that's your neckline. There's your head, it comes back. And then here's your right shoulder right here, and there's your neckline. So if you break that, typically is a sign of rolling over that the chart's going to move down for a while. However, if you hold the blue line right here, which is what we call a neckline in a head and shoulders pattern, and bounce off it, it's actually extremely bullish. That's why I was saying I think 52,000 is realistic in the near term, because we will likely rally back to that level based on just technical analysis. Again, there's more to Bitcoin, there's more to stocks than technical analysis. But I will say again, I wrote a technical analysis book 14 years ago now, and I've been reading charts for over 20 years. And I will tell you it works, because in the charts that I show you, those are Japanese candlestick charts. It shows the high of the day, the low of the day, where it opened, where it closed, all in one little candle, they call it. So you get a lot of information from that. But what I will say is the charts don't lie. The charts show the true action, the true emotions, because you're going to see the volume. You're going to see how many people are in the market or are buying and selling that day. So you know the participation. You also see those swings ups and downs. That is the emotion. So if you have people panic selling and something falls dramatically, that will be visualized in the chart. So for me, again, the charts aren't the end all be all. There's no black box out there. And reading charts is not black and white. It's an extremely gray area. Me being a very analytical guy, I like black and white. I like, tell me yes or no. When it comes to this, you can't think that way or it will never work. So again, back to the Bitcoin chart here, we're around 44,000. Again, we were below 40,000 just last Tuesday. I was talking to you the Tuesday morning, or Monday morning, we broke below it, I'm sorry. And that's a 10% increase from there. So we've seen a nice bounce. Will it continue? That's the very important part. So the next week's going to be integral. And I'm going to come back Tuesday. We'll dive into this a little bit more. The other chart I want to show you real quick, though, while we're on here, is Ethereum, Ether. And this is the number 2, the second largest cryptocurrency. And as you can see here, a little bit of a different chart. But what I like about it is it hit a new all-time high back here in November. And we pull back. Again, we're making higher lows. So this was the low from September. And we didn't even get down that low. That's a really nice sign. So again, the cryptos are looking very nice right here to me. And I think we're going to see some follow through. And again, Ether was around 4,900 where it's high. We're now at 3,372. We broke below 3,000 on Monday. So again, we're up well above 10% already from the low on Monday. And I think that could continue. So again, I'm a long-term bull. And, I was at a birthday dinner last night, and people were asking me about cryptocurrencies, which they always do, or asking me about stocks. And it's fascinating, because when things are good, people, all they want to do is buy. Tell me which crypto to buy. Cryptocurrencies have been a bit quiet here as of late, and kind of drifting lower, going sideways. And now people are asking me, should I sell everything? When I hear that, I will tell you, that's usually, again, that gut feeling, that good sign. When it was near 70,000 Bitcoin, my father, who's very risk adverse, doesn't even really like the stock market, asked me to tell him more about Bitcoin. A dear friend of mine, she asked me, buy me some Bitcoin. Not buy it for her, but show her how to buy some Bitcoin. When the two of them within 2 days came to me with Bitcoin near 70,000, I should have known that we were due for a pullback. I told both of them, I said, you're calling the near-term top. And they did. But now I'm not getting calls. And that's a great thing for everybody out there who owns Bitcoin or looking to buy Bitcoin or cryptos now. Because I really think now is probably the time that you want to be getting into it. All right, so we're going to move on here. We talked about the markets. We talked about Bitcoin. I want to talk a little bit about inflation. And if you haven't signed up yet, I put out a daily, Monday through Friday, a free daily letter. So I put out, I take usually a couple headlines, 2 or 3 headlines, and then I give you my thoughts on them and really how it affects you. I call it McCall's Call, how this affects you. Yesterday, I dedicated the entire daily to inflation. So the inflation numbers came out yesterday, CPI, Consumer Price Index. It came out for December at an increase of 7% over last year. So that's the highest we've seen since 1982. So just under 40 years. I think it was June of 82. So stocks initially rallied on it, and they pulled back, and then they closed a little bit higher. The US dollar dropped to a 2-month low on that. Interest rates, surprisingly enough, were actually down a little, and they're down a little today because I think a lot of that has been priced in. As a matter of fact, it's actually a little lower than what the expectation was. I think it was like 7.1%. So it was in line, basically, it's called. So there wasn't a big surprise by any means. People thought it would be around this level. So I took a look at this, and again, I feel like I've been talking about inflation and stuff for a while now, but it is kind of the elephant in the room. So I want to continue to talk about it. So as I mentioned, up 7%. The core number, which is the inflation number, CPI, but you remove energy and food because they consider that more volatile. That was up 5.5%. The expectation was 5.4. So again, no real surprise there at all. So what I talked about then was what does this mean for you and your portfolio and your life? Well, again, when it comes to the stock market, again, it was a bit of a muted response yesterday because it was expected. All that being said, there were certain sectors that did really well. And I'm going to talk about 3 of those in a moment. I'm just going to finish with this, but we'll talk about those and potential ways to hedge your portfolio with real investments versus inflation. The other thing is purchases. Your biggest purchase you're going to make in life, purchases I should say, are likely a house. I'm not quite sure what else you'll be buying that costs more than a home. And then your automobile, your car, your transportation. Again, you might buy other stuff that you like. Maybe you buy a fancy watch or something, I don't know. But for most Americans, it's going to be your home and it's going to be your car. So you take a look at the numbers and the shelter costs, which refers to, that's what they call the housing numbers in the CPI. They came in with an increase year over year of 4.1%. I'll tell you this, that's a hot number, that's high. I'm looking for a home right now in South Florida. I just sold a condo in Baltimore. And if I looked at prices of these homes, and I'm not as familiar with South Florida real estate as I probably should be, but if I look at the numbers as to where they were last year, they are not up 4.1%. They're up well into the double digits percentage-wise over last year. They might be up 4.1% over the last 2 weeks. It's absolutely bananas. The inventory is so low, the demand's so high, people are getting what they're asking for. Things are selling in literally hours sometimes. So it says 4.1%, but I gotta tell you, if you're buying a home right now like I am or searching for a home, that number, that real number is much, much higher. I saw this morning come across the wire as I'm up early as I am all the time reading the news that the rents in Manhattan, where I lived for a decade, the rents in Manhattan December were the highest ever. That's real money. Again, your mortgage, your rent is probably your largest expenditure every month. And most likely up more than 4.1% year over year. So I want you to know that if you feel this, you see these numbers, and you're like, well, this is much more. I feel it too. The second biggest expense I mentioned is cars, automobiles. So used car prices, because it's nearly impossible to find a new car. At least I can't find one that I want. Used car prices, just over last month, from November to December, 1 month gain, 3.5%. They continue to go up. Year over year, folks, used car prices up 37.3%. That's insanity. That means the $10,000 used car last year is now $13,700. So if you're looking to sell any used cars you have laying around, now is the time to do it. We'll probably come back to normal at some point. Supply chain issues have hurt. What's happening is I sat next to a very nice couple for drinks the other night. And they're older, in their 60s or 70s. And they had owned a bunch of car dealerships in the Northeast. We started talking business, stock market, everything like I normally do. And we started talking about their business. And they're like, oh, it's tough. And I laughed. I said, how the hell can it be tough? You can't keep cars on the lot, you just said. He's like, exactly. We can't, we want to sell more, we can't get them. So what happens is, because there's not a lot of new cars out there, what happens? There's used cars that are out there. And because demand is outpacing supply, price goes up. It's simple economics. So quite fascinating talking to him about that. So really, simply put, I just want people to know that if you're making big purchases right now and you're feeling it in your wallet, we all are. You're out there together. It's irritating to me too. And trust me, it is. The other thing is your cash. So if you have cash right now, with the US dollar falling to a 2-month low, I think the US dollar will continue to fall because obviously we printed a lot of money out there. As that continues to fall, and as interest rates will creep up throughout 2022. So first of all, cash, that means the money that is sitting in your bank account, that dollar, or even sitting right now in my pocket, is worth less and less every moment. So that is not the best thing, as a currency that we own falls. The one good thing, it could help exports because large multinationals that sell a lot of goods overseas, people buy them in dollars. And if the dollar drops, they could buy it more in their currency, and it actually helps exports. That's the one good thing, just so you know. I don't want to get too much into that. The other thing is bonds. So as I mentioned, as interest rates go up through 2022, which I think they will, during that time frame, it's an inverse reaction to the price of bond funds or bond ETFs. So as interest rates go up, bond prices fall. The reason for that is because now interest rates, the new bonds that come out every day, interest rates are higher. So the bond that you have that's paying a lower interest rate is worth less. It's just how the market works. So what you're going to see is, for example, the Vanguard Total Bond ETF, symbols BND. Heading into today, it was down about 1.3% for the year. And you say, oh, Matt, that's nothing. But it pays only a dividend of 1.9%. So you kind of wiped out your dividend for the year already. Also, as interest rates, again, continue to go up, it will go down. So that safety, which you think you have in a bond ETF or a bond mutual fund, is not necessarily safety because, again, as interest rates go up, bond funds and bond ETFs will fall. So please know that because a lot of financial advisors won't really break that down to you. They think, well, bonds are safe, bonds are safe. I'm not saying they're not safe. Nothing's guaranteed in the market, obviously. But what I am saying is you can't look at it in a way that, okay, I have bonds, I'm fine. I'll get my dividend. Well, you can get your 1.9% dividend, but the bond fund could be down 10% and you're net down 8.1%. So that's just know that can happen. I also want to talk about stocks, as I mentioned. So I'm going to come back to that as far as inflation is concerned. And there's 3 ETFs I want to bring up, and I want to talk about here in a second, that had nice days yesterday, and they're sector ETFs. And what I want to show you is just kind of where the opportunities are out there to hedge against inflation. If you're scared and you're concerned, or you just want to somehow get your money somewhere where that a sector that will continue to historically outperform during inflation, let's take a look at a couple. The first one I take a look here, folks, is the iShares S&P Global Timber and Forestry Index ETF. It's a mouthful. The symbol, which is great, I love this, is wood. WOOD. Timber, get it? I mean, these symbols are always great. So the chart you're looking at here is pretty important because what we're seeing here is yesterday. This is yesterday right here. It's breaking to a 8-month high, breaking above the high from September, as you can see. We pull back. This is what we call a W pattern, folks. You can see it. It's funny. There's a W right there. That's a W pattern. When you break above the top of that W pattern, extremely bullish. We did that on some nice volume in the last couple of days. So to me, we probably test the all-time high up around $99, $100 actually, pretty quickly. It's at $94.62 today. With the market down now, it's up another 0.2%, up about 62 cents. Very, very interesting wood here because historically, during inflation, owning land, owning timberland specifically, is one of the best hedges against inflation. So this is a nice way, and I'm sure you probably don't have a lot of exposure in your portfolio right now to timberland or stocks that are in forestry or timber. So this isn't actually a company that owns timberland or an ETF that owns timberland. It owns stocks. A lot of stocks are actually considered paper companies because they own a lot of forests because that's where papers come from, from the trees. So it's not necessarily like you're owning a piece of land, but a lot of companies do, again, own timberland out there. But again, you can see the action and very nice here. There is another one, just so you know, just to show you, there's also the Invesco Timber ETF. And get this, the symbol is cut, C-U-T, cutting down trees. So if you want to do a little bit of research, the chart's not as nice on that one for me, so it is a little bit different of a makeup. But it is also, and doesn't trade a lot of shares at all, but it's something maybe you want to look into if you're considering going into some timberland. The VNQ, we'll take a look at here, is VNQ, this is the Vanguard REIT ETF, so Real Estate Investment Trust. And as you can see here in the chart, it hit an all-time high just a couple weeks ago, and then pull back, and boy, oh boy, Look at this uptrend here. You can see this, you can draw this uptrend line right here. That's fantastic. Higher highs, higher lows, right on the 50-day moving average here. This red line usually breaks it by a little bit and rallies back. It's broke a little bit, looks like it's trying to rally back. So VNQ is a very large ETF. It's Vanguard, very low expenses, and it is a basket of real estate investment trusts. Again, this comes down to basically owning land, owning buildings, owning things. Again, that typically these hard assets, they will keep their value during inflationary times. So again, there's a trend here, and this, even though it pulled back in the last 2 weeks, this looks actually really nice right here. If you don't have any exposure to real estate, it's probably not a bad time to dip your toes in here for a little bit. The last one I take a look at is a commodity ETF. It's the Invesco DB Commodity Tracking ETF. Symbol is DBC. You can see it was up the last couple of days, right near an all-time high. It's down about 0.5% today. DBC is interesting because it's a basket of commodities. You take a look at some of the holdings, it's going to be all types of different futures, whether it be oil, whether it be, there's some gold in there. You all know I don't like gold, but there's a little bit of gold in there. Soybeans, corn, copper, zinc, wheat, natural gas, sugar, you name it, silver, zinc. So it's a very diverse basket of commodities that are both precious metals, industrial metals, grains, as I just mentioned, with soybeans and wheat. So this is, again, a nice basket, a nice way for you to gain exposure and to diversify a portfolio outside of your typical portfolio. And again, just add that diversification. Long-term diversification is great to have some exposure, and so it's not all growth stocks. Normally I talk about growth stocks, which I love, and I still think it's the best way to invest over the next 10 years. However, if you feel safer doing a little bit of diversification, there's nothing wrong with that. Take a look at some of these ETFs here that I just showed you. Before we wrap up, I want to take a look at the mailbag, if you will. And that's just some comments on YouTube. And feel free to comment and like it. That's great. They don't have to be nice. You can tell me the truth. So there's a couple of funny ones here. First one says, this guy is full of, I'll say it, shit. Personal savings at an all-time low, as is labor force participation rate. Real estate has gained zero value when accounting for mortgage rates and inflation. Growth is artificial. This guy's clueless. Well, you're viewing me, I don't give a about. Personal savings are not at an all-time low. That's just not true. Labor force participation rate is not at an all-time low. It needs to get better, yes, but it's not an all-time low, so that's not true. Real estate gains zero value when accounting for mortgage rates and inflation. That's not true either. I mean, it depends on where you own real estate, but that is just not true. When it says accounting for mortgage rates, that mortgage rates have nothing to do with the value. The fact that mortgage rates have been low actually means that if you've locked in at a mortgage rate of 3%, let's say borrowing at 3% for 30 years, that means the value of your real estate is actually going up more because you're paying less in interest. So everything that he said is absolutely not true. So I don't mind that you come at me, but please do some homework because you make yourself look stupid. Next one says, so $5 trillion in the economy, which is 40% of all dollars in circulation at this time, inflation off the rails and into the weeds, and you're trying to push optimism. Go fish. Well, I could go fish because I'm staring at the Atlantic Ocean right now, but I'm not a big fisherman. I get bored too easy. Second of all, I am pushing optimism because I don't like negative people and I don't want to be around negative people because what the hell does that do for you? Me sitting here bitching and moaning and complaining about the economy, about the government, about my neighbor, about whatever. Where does that get you in life? Nowhere. I'll tell you, when I started being more optimistic years ago, things happened. Work was better. My love life was better. Everything, it just gets better. Surround yourself with optimistic people. Sure, not every day is good. You're gonna have bad days. But I'm telling you, if you don't like optimism, don't watch this. Because we're gonna be optimistic. I'm gonna be real to you. If the market stinks for a day, it stinks today, but it doesn't mean that we just throw in the towel and walk away and have a little, sob party for ourselves. We've got to think big picture, long-term, folks. Optimism will win. Third one is Matt's book on technical analysis was one of my first books on technical analysis. Good to see quality content still being made by Matt. Thank you so much for reading my book. Swing Trader's Bible is what it's called. Next one is great show, intelligent. I will watch you more. Wish I'd pulled more out of tech and genetics at the start of November. Thank you so much again. Thanks for watching. And you're right, out of tech and genetics, I've talked about this, till blue in the face. That yes, the tech stocks and genomics and anything that's really growth related has been hit. the last few months, and we know that. But I will tell you, I'm putting together a nice wish list here, watch list, buy list, whatever you want to call it, because things are starting to look up and things are still looking pretty damn good. Next one, finally, someone with the intelligence to see something positive in our future. Now, all you have to do is muster up the courage to address the issue of our irrelevant federal deficit, which means that we do not actually have a national debt, but rather we have a pretend national debt, with this being due to the modern day advent of quantitative easing. I don't want to get too much into this, but the person makes a point that, yes, like, I don't like to see that our deficit continues to increase and we take on more debt. But because we are the reserve currency of the world, and likely will be for at least another 10 years at the minimum, because there's nobody out there that's going to overtake it. Could it be a cryptocurrency? Sure, it could be. But I think, again, that will not be widespread for another decade. So I think the US dollar will be the reserve currency for a while. As long as it's that, we can keep printing money and we can continue to buy our way out. Do we have to pay the piper eventually? Yes. I'm optimistic, but I'm also a realist. Yeah, at some point we have to pay the piper. I just don't think it's anytime soon. Next one says making money for Matt, not making money with Matt McCall. Another YouTuber pushing you to the top of the mother of all bubbles. We all are entitled to our opinion. I do not think this is a bubble. If you want to compare it to 99, 2000, there's no comparison, honestly. So the thing is, with the market, folks, there's a buyer and seller, and every time you hit the button, if I'm buying, you're selling, it's okay. We're still friends. It doesn't matter. And last one was, chart patterns, the astrology of the trading world. The fact he applies it to indexes is even more amusing. Again, get your facts straight. This person says the fact, get your facts straight. Every investment firm, every person I know who's ever been successful investing implements technical analysis to some extent. And using it for indexes, that's where you use it. It shows, again, the real emotions behind the market, what people are doing. If you don't use charts, I think you're absolutely bananas. You could find a company you love. It's everywhere, every corner in the world. You love their products. The fundamentals are good. The stock's down 80% in the last 3 years. What's going on? It's at a low. Something's going on you don't know about. So I always look at the charts before I ever buy something or recommend a stock. It's very, very important. Again, keep the mailbags coming. I'll cover every once in a while. And I'll cover a lot of negative ones. Excuse me, only because I think it's good to show people, okay, listen, I read this. I know, I get it. And I try to do better every time. But I'm not going to make everybody happy. And my goal is if I can change one person's life every show that I do and help them investing, my goal is there. Hopefully it's many, many more. But again, share, like, comment, good or bad, we'll take them. Again, thank you so much for watching. I'm Matt McCall, and this was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.